This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Now we'll look at prices in a little bit more detail. And the influences on prices are as follows. First of all, your mission and marketing objectives. Your mission and marketing objectives is really how you perceive your position in the market. Whether your mission is, for example, to sell high-end products or cheaper products. If you are setting yourself out to sell luxury products, then it is slightly incompatible to very low prices. Similarly, if you say that you are offering value for money products, it doesn't make much sense to very high prices. So pricing cannot really be separated from mission. Mission sets the purpose and the market position of the organization and sets the initial kind of price levels. Mission and marketing objectives are kind of fairly permanent features and influences on pricing. However, from time to time there are short-term requirements, and this is the pricing objectives. For example, if you go into a high-end store, say in January, just in a new year, you'll probably find sales on, and maybe many of the articles have been sold at half price. So what the company is doing there, its pricing objective, is partly to get rid of old stock and to make room for the new maybe summer stock which is coming in. And sometimes they might be having cash flow difficulties and they reduce the price of their goods just to generate some cash in a kind of emergency basis. However, this is usually temporary, and all being well, the prices will kind of bounce back to the levels which is dictated by the mission and the marketing objectives. Other influences, of course, costs. You have to try to cover certainly your variable costs. If you can't cover your variable, your marginal costs, you're rather wasting your time. But ultimately, the prices have to be high enough to cover the fixed costs as well. You can't just say that cost plus a percentage, cost plus pricing is going to be the selling price. You still have to look at what competition is doing, what the perceived value of the product is as well. But everyone will look at cost and try to set the selling price above cost. We then have to look at competition. And we have four types of competition here. We have perfect competition, oligopoly, monopoly, and monopolistic competition. So perfect competition really means you've got very little choice over price. You're selling pretty much identical goods to everyone else, and you have a market price which is dictated to you. The opposite really is a monopoly, where you have complete freedom really over the prices you set, although of course you may set the prices so high that you extinguish all demand, but it gives a lot more flexibility. An oligopoly is a small number of major suppliers, typically in the oil business, the petrol business, where maybe you've got four major suppliers in any one country. Here they all tend to watch each other a little bit. If, let's say, Shell decreases its price per litre, then the other ones tend to have to follow, otherwise drivers will simply go into the Shell garages. And if they're not careful, they simply end up with all the suppliers charging a bit less and actually all losing out on revenue. If one tries to put the price up, then the other ones can sit still and they don't have to follow. So nobody really wants to rock the boat very much. They tend to not put them up, not put them down very much, because there are dangers in doing that. And finally, there is monopolistic competition. That looks like a contradiction in terms. How can it be both a monopoly and also have competition? And we can see this in the car industry. We could say that maybe a Ford Mondeo, a General Motors Vectra, whatever they're called, maybe a Volkswagen Passat, that kind of size of car, are in competition with each other, roughly the same size, roughly the same engines, roughly the same specs, and so on. They are in competition with each other, but nevertheless each of the makers tries to make itself distinct from the other ones. So maybe the Volkswagen one will trumpet about quality and the like. maybe another one, maybe if you're the Skoda one, also made by Volkswagen, maybe it would say you get quality but at a cheaper price, and so on. If you're talking about price competition, then consumers are motivated primarily by price. They will tend to buy the cheapest article. Non-price competition means you are competing in something other than price. It could be style, it could be quality, it could be brand. And this is really a differentiation or focus strategy. Next, the influence on prices would be consumers. How will consumers react to a change in price? If you have goods which are essentially a necessity, putting up the price will not decrease the demand very much. Putting up the price will tend to increase revenue. If you have goods which are luxury goods, then the chances are putting up the price will decrease revenue because people can do without these luxury goods. They tend to be more price sensitive. If you talk about a high elasticity of demand, it means a very price sensitive. A little increase in price will make demand fall away very quickly, and the revenue will probably decrease. A low elasticity of demand means that the volume is relatively unaffected by price changes, and you could put your price up and the volume stays pretty buoyant, and you'll increase your revenue. Finally, some industries are controlled by statute. It used to be much more common than it is now. When I was a child, the price of a loaf of bread, a litre of milk and so on, was really all controlled by the government. Now most countries have a much freer, non-controlled market economy where you don't get prices and regulations. In the UK, the only areas which are really subject to regulation are the utilities like water and telecommunications and gas and electricity. Here it's not so much that the price is controlled by the government or set by the government, but if somebody wants to increase their prices, then they have to go through a controller who will regulate those. Setting prices. What are the methods in which prices can be set? And if you're lucky enough to have the information, then the scientific or economic approach is to have marginal cost equals marginal revenue. Marginal cost might simply be the variable cost per unit, but marginal revenue implies that you know the demand curve. It implies that you know for every decrease of $1 in price, you know how much the demand is going to increase. And not that many businesses know that. So although this is theoretically good, in practice, it's perhaps of limited applicability. You can set prices to break even. This implies making a guess at the volume that you're going to sell, and you set the price just to break even at that volume. You can have cost-based pricing, cost-plus pricing, and the like. This means you take the cost, let's say 80, you add on 25%, this will bring the selling price up to 100. It will leave you with a profit of 20. Of course, there's no guarantee that you'll be able to sell these goods at 100. So although everyone does cost plus pricing, you then have to look out and see what the competition is doing, see what people might be thinking of the article you're trying to sell, and try to imagine whether they would buy it at that price. Competition-based pricing means that you look at the competition and you kind of focus on that, excuse me, maybe juggling your price up and down a little bit, maybe to do with the perceived quality or the brand or something of that sort. But you're staying pretty much in line or taking your guidance from what the competition is doing. Market-orientated pricing, you're really trying to put yourselves in the shoes of the buyer and say to yourselves, would I buy at that price? What is this article offering me? If I were buying it, do I think it's too expensive? Do I think it's too cheap? You may have to do market research to try to find this out. And finally, as we mentioned earlier, there's the strategic approaches. We have price skimming, we have penetration pricing, we have related product pricing, all of which can play a valuable part in trying to maximize a company's success.